U.S. natural gas futures edged lower early Monday after briefly spiking above the 200-day moving average overnight. The January contract touched $4.50 overnight, surpassing the 200-day moving average at $4.45 before sellers stepped in. Despite headlines highlighting record cold across the East Coast, the rally quickly lost steam as traders focused more on extended forecasts than on current weather conditions. The swift reversal underscored market skepticism about the durability of short-term weather-driven gains. While brief cold outbreaks continue to make news, futures traders remain concentrated on 10 to 15-day trends, which currently point to moderating temperatures. Although parts of the eastern U.S. are seeing lows in the teens to 30s, national demand is expected to ease later this week as much of the interior warms above seasonal norms. The 8 to 14-day outlook still leans warmer than average, keeping a lid on bullish enthusiasm. Meanwhile, long-range models still hint at a potentially colder start to December, though that outlook remains uncertain for now. However, until those projections solidify, traders appear hesitant to price in a lasting rally. Even the latest weekend updates, which added several heating degree days, did little to shift the broader expectation that mid-November weather remains neutral to slightly bearish for demand. One supportive factor for the market is record-high LNG exports, which recently reached around 18.5 billion cubic feet per day. This strong export demand provides a price floor but hasn't been sufficient to counterbalance the bearish weather outlook. As a result, traders remain cautious, waiting for clearer signs of a sustained cold pattern before adding new long positions. In my view, the 50-day moving average at $3.95 has now become the key technical support, even more significant than the 200-day average. If this level holds and we see a shift toward colder than normal conditions later in the month, there's about a 40% chance of a rebound toward $4.45. However, the probability still favors the downside, around 60%, especially if prices slip below the $4.30 pivot. With weather models leaning warmer in the 7 to 15-day range and limited technical backing above $4.30, the short-term tone remains bearish. Unless a stronger and more persistent cold pattern emerges, any rallies are likely to be short-lived. For now, I believe traders should stay cautious. Patience and discipline are essential in this setup. Don't forget to leave a comment and check out the ads to support the channel. See you in the next one.